So as most of you know, my name is Chandler Jordan, and I am the program director for SC Economics. We are the South Carolina Council on Economic Education, and I specialize in offering support to econ and personal finance teachers throughout the state. I'm also known as your bestie for the resty, but we'll leave that aside. Tonight, we have our last webinar of our fall series, but don't you worry. We are going to bring a spring series as well to you, hopefully to announce that as early as next week, if not early January. But just know that these are not going away, but this is our last one for the fall. So thank you for all of you who have tuned in with us this fall. We are super excited to have Joanna Saboot with us. She is a South Carolina financial literacy master teacher, and she is going to talk to us about the home buying process and how we teach that to students, but more importantly, how we teach students to plan for the future, whatever that means past high school. So thank you so much for being with us. I'm going to turn it over to you. I will manage all of this waiting room stuff, and I will manage all of this chat stuff, but feel free to just say my name if you need help with anything. I am here to support you, but thank you for being here, and I'm going to turn it over to you.
Thank you, Chandler. Thank you to everyone that's on here. I'll just give you guys a little quick background about myself. I am a business education teacher at Dixie High School. I've taught personal finance, Google App Suite. Now we're teaching coding. I've taught administrative tech support. So I've taught a number of things. And I found this love when I started teaching personal finance. And so one of the things that I do with my students, and this is how all of this stuff got started, the goal in personal finance was to teach my students how to get their money back. And by money, I mean the money that we pay out in debt or in bills and different things like that. Like, we want to be cognizant of what we're spending out, whether it's in late fees, whether it's in interest rates, whatever it is. We want as much of our money back as possible. So you guys will see in the presentation, and I'll explain to you guys a little bit how we did it in the class. There was a build up to it. We looked at buying versus renting, and the students were able to decide which preference worked for them. So one of the first things that we did was the students were able to pick a desired job. And once they picked a desired job, they were able to go online and look up a proposed salary. And based off of that proposed salary, we worked in creating a budget and then them house shopping and looking at the different types of loans. So we'll get into the presentation. Let me share my screen with you guys, so we can see that. Okay, so of course you guys know the name. We've registered, helping students plan for the future, home buying. Okay. Objectives: students will learn how to acquire a home loan using credit. Students will research different types of home loans and determine which one is best for them. Students will match income with the desired home price and type of loan. The standard that this go along with, and there's other ones. I just picked one that I kind of felt like would align with that in a broad spectrum, so that if I wanted to include something else, I could. Students will determine financial responsible ways that individuals acquire credit. Students will research and analyze. I can't see it because you guys' faces on the side. Students will research and analyze the factors that impact personal income and long-term earning potential. Okay, so as of this stuff was done last year, right before COVID hit. During that time, the average cost of homes in South Carolina was about $170,000. So I wanted to make sure the students were aware of that because, again, we're trying to prepare for the future. So we don't want to set any unrealistic expectations. So when we're looking at jobs and different things that we want to do, we want to at least make sure that these jobs are enough to cover necessities. And the home would definitely be one of them. And then some of the current rates. Now, this was as of 3/25/2021. We understand and we know that due to COVID, a lot of the interest rates went down. One of the things that I teach my students is to pay attention to the times. When you're talking about getting your money back, you want to be aware of the time, because if you're aware of the time, a lot of these things that happen, i.e. COVID, instead of it being a burden to you, now you will be aware as to how you can make this time work for you. So my goal is to always teach them to look at the times and figure out different ways in which they can make the times work for them. So if they were purchasing a house now during this time, of course, we talked about interest rates. And they definitely know that we always want to shoot for the lowest interest rate on the fixed year term, whether it's 30, 20, or 15. We have already talked about certain loans that we should avoid, especially when we're talking about our financial well-being. So here's a few terms, a few mortgages I kind of went over with my students so that they would know what type of loan worked best for them. One of the things that I talked about with my students, we discussed well before we even went into buying a home, we talked about the recession in 2008, because a lot of things happened with the housing market in 2008, right? There were so many subprime loans giving out. These lenders were giving out loans to people that they knew could not afford the loan. And so when everything crashed, no one was there to cover the loan. And the insurance, it was so many people with defaulted loans that the insurance that was on these mortgages could not cover, because so many people defaulted. So one of the solutions that that was brought about was what we call PMI insurance. So I always tell my students, if you're looking at a mortgage and you're looking at putting less than 20% down, and even some mortgages, some conventional loans require PMI insurance, you want to make sure that you've calculated the PMI insurance as well as your mortgage payment and as well as your regular home insurance. So what is the PMI insurance? The PMI insurance is an insurance that is put inside of your mortgage to cover in case of default. All right. And this is mostly done with subprime borrowers. This is mostly done with FHA loans and different things like that. These are the loans that doesn't require that high of a credit score. And so one of the things that I talk to my students about is the higher your credit, the more leverage you have and the more of your money you will get back, because low credit scores means you're going to be paying more interest, means you're going to be paying more money out of your pocket. So you're going to be losing more of your money rather than getting it back. When you have a higher credit score, lower interest rates, and then you run a better chance of keeping your money and or getting some of your money back. And so with the PMI insurance, it's basically, and this is how I explain it to my students, it's basically saying, I am covering just in case I default on my loan, okay? And so the PMI insurance can raise a mortgage anywhere from $200 to $500. So you definitely want to be aware of that. Also with the PMI insurance, after you have stayed in your home for a certain amount of time and your home has went up in value, now you have the opportunity to call your mortgage company and get the PMI insurance dropped. If you don't call, it won't get dropped. There's nothing that they're going to approach you about. You have to be aware and you have to know. We're always looking at the time so that we can find different ways to get our money back, especially when it comes to something as major as a mortgage. When we're looking at interest rates, the students were taught how to calculate interest rate, and they know the difference. It could be a $60,000 difference between a 2% interest rate and a 4% interest rate, around about. So we have to think about all of that stuff because we're always looking for ways to get our money back, even in times of us thinking about refinancing. If we're already in a mortgage and we run into times like COVID and interest rates have dropped, we want to be able to calculate the benefits of or not refinancing your mortgage. Okay. So these are all the things that we kind of talked about, but we kind of went over the terms so they can get an understanding of the different types of mortgages and what would fit them. So we have a straight term mortgage, and this type of loan includes only interest payments and no principal. Your loan balance is going to stay there. The only thing you're paying is interest. You're not paying anything else. So your principal balance will still be there. The interest only loan is similar to rent, but with the possibility for appreciation and better tax write-off. That's the only benefit from a straight term mortgage is the tax write-offs, all right? And then you have a fully amortized mortgage. A fully amortized loan is paid off in periodic payments of principal and interest over the long term. As the borrower makes payments according to the loan amortization schedule, the debt is fully paid off by the end of its set term. As the loan is a fixed rate loan, each fully amortizing payment is an equal amount. As the loan is an adjustable rate loan, the fully amortized changes as the interest rate and loan change on the loan changes. And then you have a partially amortized mortgage. This is called a balloon mortgage. And to kind of sum that up, you're paying payments, and I want to make it as simple as possible. You're paying payments, but when you have a balloon mortgage, at any given time, the mortgage company can say, hey, we want the rest of the mortgage, all right? Or we want to raise your payments, especially when it comes to time of maturity. So if you paid those payments and your loan is mature and the bank comes back and say, hey, we want the rest of the loan, we want it now. And if you don't have the money to pay it right then and there at the end of the term, then you run the risk of possibly losing your home and or your loan. And it can kind of seem somewhat appealing because it's spreading payments into smaller regular payments over time. Adjustable rate mortgage. It is a mortgage with an interest rate that is linked to the economic index. It carries some benefits, and then of course, just like it has pros, it has cons. So when the interest rates that are linked to the economic index are low, guess what? The interest rate on your home is low. But when they go up, the interest rate on your home goes up. One thing about the economic index, there are times where we can kind of somewhat predict it, but to kind of be 100% accurate on predicting the economic index, it's just sometimes it's impossible, because again, we can have things like COVID that happens and it happens unexpectedly, and then you're not prepared if you're banking on you being able to predict the economic index. Okay, so these are terms you want to look at when you're looking at your paperwork for your mortgage. These are terms you want to familiarize yourself with, and you may not even know what it means, but if you remember the word and you link something to adjustable rate that will help you remember it, then you'll know, like, hey, wait a minute, I don't know, this may not be the loan for me. I don't want to think about my payments raising because the interest have raised. I want something, and I want something set. And this is a conventional mortgage loan. This is your loan that you typically get from banks. These loans carry a 20% down payment. In most cases, these loans do not carry a PMI insurance because you've already put down 20%. And in order for you to get approved for most conventional loans, you will not be a subprime borrower anyway. This type of mortgage is not insured or guaranteed by the government. This loan is backed by private lenders, and its insurance is usually paid by the borrower. Again, there is a chance that there will be PMI attached to it, but more cases than not, there won't be because you've already put down 20%. Reverse annuity mortgage. A reverse mortgage is a type of home equity loan that allows you to convert some of the equity into your home into cash while you retain home ownership. This mortgage works like traditional mortgage, but in reverse. Instead of you paying the lender pays you. And these are the loans that I've been harping on this whole time. These are the things we want to stay away from because we want to get our money back. And if we're borrowing on subprime conditions, borrowing from subprime loans, we will not. We will lose more money than we actually keep. And then the goal here too, also with buying a home, the students need to know that even though we have in our minds we're going to buy a home and this is where I'm going to be settled, they need to always have in mind, as we're always thinking about getting our money back, they always need to have in the back of their mind that eventually, maybe one day, I am going to sell. And if I am going to sell, I want the most profit for my return. Okay. And so in a sense, we're kind of looking at purchasing a home like a business transaction. If you look at your life like you are an organization, right? And you're going to run your life as such, then when you purchase a home, it is a business transaction. And you want to do what's best for the organization as a whole. And so at any given time, you want to be prepared to sell. And when we're purchasing homes off of subprime loans, a lot of times that put us in a tight spot because the interest and the fees and things are so expensive. By the time we do get to a place where we want to sell, it takes away from our profit. And so we want to make sure, again, the goal is to get our money back. So we want to make sure that we stay away from these type things. Subprime borrower is one who cannot qualify for prime financial terms. This is somebody who has bad credit. And with my students, by the time we do this presentation, we've already went over what bad credit is. Okay. Most subprime borrowers, in order to qualify for a subprime loan, they require you to have a credit score between 550 and or 600. My students know already we want 600 or better. Okay. So they already have an understanding of what a low credit score is. They also know that your credit score is calculated 30% based off of your payment history. So they know in order to get good credit, we want to make sure we make our payments on time. And that's why we're always looking for ways to get our money back. The more money I have back in my pocket, the more security I have, and chances are more likely for me to pay my bills and pay them on time. So the students they are very, very familiar with that. The failure to qualify for prime financing is due primarily to low credit scores. Subprime lending costs are higher because more applications are rejected and marketing costs are higher. Okay, most of these people who market subprime loans, they know exactly what they're dealing with. Okay, and the interest rate is going to be so high off of the rip because they already know chances are you may default. That's just because of your credit score. That's the title you got. So that's the business of that. Open-end mortgage. This mortgage allows the borrower to increase the amount of the mortgage principal outstanding at a later time. Open-end mortgages permit the borrower to go back to the lender and borrow more money. Many refer to this form of mortgage as a home equity loan. Okay. And same thing like we talked about earlier with the reverse annuity, it's the same thing. They took out money against their home. I mean, a lot of people typically do that. And I'll explain to my students, a lot of people typically do that to make repairs. They just may have hit some hard times. And so they'll do that to kind of like keep from struggling as much or losing their home and so forth. A wraparound mortgage. It is a form of secondary financing for the purchase of a real estate property. A form of seller financing where instead of applying for a conventional bank mortgage, a buyer will sign a mortgage with a seller. So this is more of your lease to own or owner financing. Okay, this is what a lot of this comes from. And a lot of people do this in a lot of investors or somebody who's just starting out investing and they may not have enough equity to get an investor's loan or a hard money loan. They will speak directly with the owner and try and work something out for the owner to do owner financing. And then that way they pay the owner of the property that they're looking to invest in. Sell and lease back. An asset that is previously owned by the seller is sold to someone else and then leased back to the first owner for a long duration. This arrangement allows the initial buyer to make full use of the asset while not having capital tied up in the asset. So somebody may have came to the conclusion, hey, I want to sell the house and I want to, if there's profit coming back from me selling the house, I want to pocket the profit, but I still want to rent. Renting for a lot of people is more convenient because it's less responsibility. You have your landlord or the property management that comes in and make repairs and do all that kind of stuff. Whereas when you're purchasing your own home, you have to be prepared to make repairs and do things yourself. And that is why, and I explain to my students, that is why it's very important for us to have and keep an emergency fund. Okay. We should already have an emergency fund established before we even thinking about purchasing a home. And no, we do not take the money from our emergency fund and put down as a down payment on the home loan. The emergency fund is just that. It is for emergencies. It is for repairs, not only with your house, but any emergencies that may arise. So we will not use that money for a down payment for a home. Okay. And then we have negative amortization. Negative amortization means that even when you pay, the amount you owe will still go up because you're not paying enough to cover the interest. Okay. Negative amortization occurs whenever the loan payment for any period is less than the interest charge. Again, these are things that we want to stay away from. If you really want to be honest, students, we want to get a house that we can afford to make the required payments and more. Okay. Because the more we pay, the more interest we get, the more of the principal we get to pay down, and then we kind of get an opportunity to curb the interest. So that is why it's important to know our budgets, know what we can afford, know how much we're actually making before we even consider getting a house. That way we already have a plan going into it, and we know how to attack our loan, attack our debt. Okay. A construction loan is usually a short-term loan that provides funds to cover the cost of the building and rehabilitating a home. Construction loans have higher interest rates than longer-term mortgage loans, and they use to purchase loans. The thing with construction loans, you want to make sure you have a set start and finish date, okay? Because you don't want the loan to start rolling and the contractors are not finished building your house, and you're paying on a loan for a house that you're not even staying in. So when you get a loan like this, you want to make sure that you are well aware of what is required, well aware of what the contractor should be doing, and by what point in time they should be doing it. Because it doesn't make sense to be paying on a loan for a house I'm not even staying in, and then I still have to pay for wherever I'm currently living. Again, things like that will cause us to lose money. So we want to make sure that we are fully aware of that. A package mortgage, it is a mortgage covering major items of equipment in addition to the house and the lot. A package mortgage loan allows for the borrower to finance both real and personal property together. The first thing that comes to mind, if we're making it simple and not overthinking it, you start thinking about a package loan. This is just the land. It's almost like land home package, okay? And then there may be other things that you kind of want to include in that you can include in that. And the first thing that comes to my mind is like mobile home, okay? A blanket mortgage. This is a type of loan used to fund the purchase of more than one piece of real property. Blanket mortgage loans are used much by developers. This is something that we probably won't even run into. A developer can purchase a large tract of land and subdivide it and then sell off individual lots. Unless we're looking to invest, this is probably something that we won't even run into. Purchase money mortgage. Purchase money mortgage is issued to the buyer by the seller of a given property. Such a mortgage is used when the seller is also the lender. This form of owner financing requires the title to pass to the buyer at the time of the agreement. Okay, and this is just a shift of responsibility, basically. Okay, the title is in your name, and you're responsible. FHA insured mortgage loan. Now, these are loans that are insured and backed by the government. These are the loans that you could possibly get in with a 550 credit score at the lowest, moving on up. These are the loans that will also carry PMI insurance, the PMI insurance that I was talking about earlier in the presentation. FHA insurance mortgage loan is a U.S. Federal Housing Administration mortgage insurance-backed mortgage that is provided by an FHA-approved lender. FHA insures 100% of the loan. Interest rates on FHA loans are often about the same or slightly higher than traditional mortgage loans. And then you have your PMI that is usually attached to this FHA loan, which no wonder the government can or will fully back it. And it's the type of mortgage insurance you might be required to pay for if you have a conventional loan. A lot of this stuff comes with the FHA too. VA guaranteed loan. Now, if you are a military member, you will be eligible to receive the VA guaranteed loan. A VA loan is a mortgage loan in the United States guaranteed by the United States Department of Veteran Affairs. A VA loan will guarantee a maximum of 25% of a home loan amount of up to $104,250, which limits the maximum loan amount to $417,000. A VA guaranteed loans are made by private lenders such as banks, savings and loans, or mortgage companies to eligible veterans for the purchase of a home, which must be for their own personal occupancy. The thing with a VA loan is there's a required years of services that you must meet in order to be eligible for a VA loan. There are certain standards that the VA require you to meet before you're eligible for a loan. Also, the VA loan, a lot of people, especially private military members, love the VA loan because it's 100% financing, which means no closing costs, none of that stuff, no down payment, any of that with a VA loan. Not no closing costs, but no down payment. And if you're lucky enough to negotiate the seller paying your closing costs, then you definitely will have it made with a VA loan. And then we go over terms such as mortgages. A mortgage is not a loan. A mortgage is actually a lien on the property which secures the loan. And mortgages are a way to buy a home without having all of the cash up front. So not to conflict with our teaching in personal finance, I use the Dave Ramsey program. So not to conflict with Dave Ramsey. Obtaining good credit can be done through using your Vantage 9 score, which is basically means that your credit score has been calculated based upon you paying utility bills and or rent if you're paying it somewhere else, versus having to build credit in a traditional way, such as credit cards or automotive loans and stuff like that. Because we know Dave Ramsey tells us debt is dumb and cash is king. So we definitely want to make sure we keep those things in mind when we're trying to determine what is best for us. Okay. So after my students learned this term, they went on a search. They went on a search for houses, and they had to do a report. All right. They had to do a report explaining the house they found, why they felt like it was a better fit for them, the pricing, as well as explaining the type of loan that they were going to try to get in ways in which they thought that they were eligible for the loan. So I've done a lot of talking. Is there anybody that has any questions, any comments, or anything like that?
I first want to let you guys know that I am going to share her presentation with you. So you will have access to all of that information she just shared in our follow-up email. But that was a lot of information. I actually learned about some mortgages that I didn't even, or loans that I didn't even know existed. So that was awesome. What did you guys learn? What is something that stood out to you, or any questions that you have?
Hi, Chandra. I just would like to make a comment in that I thought the presentation was great. I would add or discuss inflation. And when you talk about buying houses or homes now, during COVID, so although the interest rates are low, the prices of homes have gone up, and kind of get into why, looking at the material costs and so on and so forth. So that's the only thing that I would kind of add to that.
And the students know when we talk about the ups and the downs, because I taught this last semester, so I taught this dead smack in the middle of COVID. And so the students know that they have to be aware that, you know, the prices of the houses, even though the interest rate is going down, the prices of the housing is going up. So they have to figure out what fits better for them. Which one is more important, the price or the interest rate? And in that, they do a little bit of the calculation to see, okay, how much more would I have paid over time using this interest rate, and then comparing it with the current price, and different things like that.
I'll comment. You just gave about a 5 hours worth of instruction in this workshop, and you're well on your way to getting a real estate license if you pour over this. I would say a lot of these terms, and I will tell you, I think my background will tell you that I think you're very, very accurate in what you've given, and it does, about 60%, I think this comes and goes a bit, but about 60% of Americans own their own home. There was an effort to increase the home ownership by both political parties back in, 10, 15 years ago. And it turned out not very well, which is what you talked about when the sort of the crisis came, and an awful lot of people lost their homes. We have a similar situation that could occur looking forward, because interest rates are going up. And if you've gone into like an ARM, renewable type of thing, your interest rate may make your home loan unaffordable. You own it, and then all of a sudden the interest rate keeps going up and up. And then after a certain period, maybe 5 years, all of a sudden you get your loan readjusts automatically, and you find yourself with a loan that you can't afford the payment. So it's there are things to pay attention. You mentioned it too about the risk. Gosh, nobody should be buying a house until they've got not only their down payment, but also the money that they might need should a risk come along. But I mean, what you gave an awful lot of great information out there, and I'm glad you recorded it, because if people want to dig more into it, they need to just watch it and put it on slow motion.
I was talking fast. I'm sorry. I tend to do that.
That is okay. That's why we record it. And again, we're going to share out the presentation so you guys can kind of go through it. Stephanie, were you going to say something? I feel like you had unmuted yourself for a second.
I just want to know when she teaches this class. I'm gonna come back and get part 2. No, I thought that was good. I would say you definitely gave a lot of. I was over here typing to myself, trying to look. I'm gonna share it with some friends of mine that need this same information. But do you talk to your students about like how, I guess, any programs that may have come about to help people buy loans during this pandemic, or like any like other programs like building up like their careers and stuff, like how
we've talked about the possibility of different things like down payment assistance and stuff like that, but I try to stay away from that kind of stuff because I want my students to fully have in mind from their resources, how am I going to do this, versus getting them to a point of thinking, well, if I can't, then I'm gonna go out here and I'm gonna get help from this and that. Because if they start off young with saving, with planning and all of that stuff, then they're going to be more than capable of doing it. So I try to, it's a lot of information, and I know, and I even thought about it myself, like, wait a minute, it may be too far-fetched for the student. But after I started reading some of their reports, a lot of them got it, and it wasn't. And so, and it was, I wanted to be as real as possible. Even when we did our credit portion, we talked about what ways you can get good credit. And I also taught them how to fix their credit should they mess it up. So I wanted the personal finance class to be tools that they really would and could use. Starting now, we talked about ways that they could actually build credit. Them being added onto one of their parents' credit cards as an authorized user, or them even starting their own bank account and getting a secured credit card if there was something that they were that serious about. Because I try to not steer too far away from Dave Ramsey because that's the curriculum we use. But I also want to make sure that they're aware of all of the resources that are out there.
Gotcha. Great presentation.
So Joanna kind of told us about the report that she has students create in regards to loans. Do you guys have anything that you do with your students that you'd be willing to share out with us? Any activities or any information that you do just to kind of diversify like the activities that can be done? Obviously, I think this is one of those things where you've got to inform students, you've got to give them all of the information up front, but then really having them digest it through a report is where you'll really be able to see their learning. So I'm curious if you guys do anything in your classrooms that kind of speak similar to what she's talking about. Anyone want to share?
I just tell my students that it's rough out here. But I do take them through kind of like what you said, Ms. Moot, as far as kind of showing them like budgeting and saving and how key it is to have a certain amount, because a lot of students just think that, oh, I can just go get this house, I got this amount of money. It doesn't work like that. There's steps you have to take, and just even taking them on something as simple as Zillow and letting them see about how much stuff would cost and the cost of living in different areas. Because a lot of them say, well, I want to move. I say, well, can you afford to move? Or when you do move, how much is it going to cost you compared to here? So that's some of the stuff I like to do, compare and contrast salaries, like she said, like you said, Ms. Smoot, as well as just kind of showing them about how much life is going to cost them once they really are grown, not just claiming being grown.
Yeah, this also dovetails in very well with other basic fundamentals of personal finance. I mean, you can't get there without good credit, as you've already mentioned. I mean, you might be able to, but you put yourself at a huge risk. You also can't get there unless you've learned how to save. You know, if you can't save an emergency pot, you sure can't be, shouldn't be out there buying a house. And finally, you know, this dovetails in with insurance, because you can't take on the risk of an entire house without having insurance. First of all, no company's going to loan you money unless it has insurance. So, I mean, these things all dovetail together. A home ownership is the most wonderful thing in the world. But only, you know, again, there's 40% of the people that can't get there because they have not learned how to save or to, you know, get their credit at the right place. So, and other reasons. Thanks.
No, I think that's great. Anyone else? Anyone else want to just share out something either they learned or something they would like to know more about?
Someone put in the comments to do a word wall, and I thought that was like an awesome ideal, especially when it comes to the personal finance classroom.
I think that's great too, because that visual learning, you know, aspect of it for them to be able to see these terms, to be able to comprehend them. You know, I think that's great. And I know you also talked about how you go through renting, and you know, I think a lot of students don't understand that sometimes that, you know, how expensive it can be to rent. Renting is very expensive, and so doing a good analysis between the two, and letting students who think they're grown actually know what it's like to be grown. So I think that's awesome. All right. Any other questions? I know it was a lot of information and it was quick, but I am not going to hold you just for the sake of doing so. So anybody have any last minute questions or follow-ups that you would like? And again, I'm going to send this presentation to you with a follow-up email. Any last minute questions for Ms. Smoot?
Just thank you very much on behalf of SC Economics. We really appreciate you not only well, just participating in the program and presenting. I know you can't make a presentation without being prepared, and you clearly took a lot. You know your stuff, so that's really nice. And other people can reach back out to you with individual questions, and maybe you can answer them at a slower pace.
Yeah,
yeah, no, for sure. And if you don't mind, I will share out your email when I send out the follow-up, and so you guys can reach back out if you have any specific questions. As you guys know, or most of you at this point know, Joanna is one of our South Carolina Financial Literacy Master Teachers, which means because you were in this session tonight, you are eligible to earn $100 if you teach some sort of financial literacy lesson in your classroom. I am going to send out all the details of that with my follow-up email in the morning. But for tonight, the last thing I need you to do is I've just dropped in the chat is the feedback form for SC Economics. What this does is this helps us create more professional development like this, informative professional development, but also gives you credit for your session tonight. If you've joined us for 5 sessions this fall, you're also eligible for another incentive. So I definitely want you guys to take a few minutes and fill that out. But once you have filled it out, we are done. We're releasing you to all of the other things you have on your to-do list for tonight. So thank you, once you guys fill out that form, for joining us tonight. We really appreciate it. I'll stick around for a few minutes if you guys have any other questions. But other than that, have an awesome night. Thank you, Joanna. We really appreciate it.